All right, so what is a double bull spread? Well, to keep it simply, a double bull spread is an options trading strategy that we use when we have a bullish outlook on a stock, but we're also pretty confident that the underlying share price of that stock will not fall lower than the strike price at whatever the strike price is that we choose for our put contracts. So basically, how we open up a double bull spread is by opening up a call debit spread and a put credit spread at the exact same time using different strike prices on the same expiration date. And so what that would look like, for example, is let's say that I were to buy this 118 strike call option and then sell this 119 strike call option right here. That would give me the call debit spread, and I would incur a total cost of about 40 cents around there. And then I would want to open up a put credit spread. So right here, I open it up for the 118, 119, and I'll open up a put credit spread for the 115, 114 strike. So I sell the 115 and then I buy the 114 strike put contract. And that right here gives us a double bull spread. And we can see that the chart sort of looks like half of a call debit spread with the other half of a put credit spread. And we can see that this strategy in this case, we can open it by incurring a total credit of 10 cents per share or $10 for the whole strategy, since with options we're dealing with 100 shares. So we would basically be getting paid to open up this strategy. And basically, like I said before, our outlook is that the stock will go up high enough to make the call debit spread in the money, so the share price would rise above the strike of 119. And we're also selling the put credit spread to mitigate the cost of opening up the call spread. And so obviously in doing this, we end up having more downside risk exposure, because if we were to just open up the call debit spread without opening up the put credit spread, the total amount we could lose would be 40 cents, because it's just the cost of whatever we spent to open up the call debit spread. But with the double bull spread, since we're also opening up a put credit spread, our total loss actually increases a little bit because our total loss is no longer the amount that we spent to open up the call debit spread. Now our total loss is the difference between the strike prices for the put credit spread minus the total credit that we received. So in this case, since the difference between the strikes is $1 and we're receiving a total credit of 4 cents, that means that our max loss is going to be about $96 for this strategy, because the difference is about 100 minus, or now it's $3, so the max loss would be $97. And so it's possible to actually open this strategy for either a credit or a debit initially. And the reason why that is because if the put credit spread, if we end up collecting more credit for the put credit spread than we pay to open up the call debit spread, then we'll incur a total credit. But let's say that I sold this put credit spread at different strike prices, so slightly lower and not as at the money as the last one. So in this case, we can see that when I shifted the put credit spread down to lower strike prices, the spread between the premiums for these two contracts decreased, because obviously when we have a spread, the closer the spread is to the underlying share price, the wider the spread will be. And the further the spread gets out of the money, the less large that spread becomes. And so in this case, the put credit spread, we're actually collecting less credit by selling the put credit spread than the debit we're paying to open up our call debit spread. And so that ends up giving us a total cost. And so in this case, like I said before, with the max loss, where the max loss when we incur a credit was the difference between the strike price of the put contracts minus the total credit we received. Now our max loss is, or at least when it says total cost, it's the difference between the strike prices of the put contracts plus the total cost that we received for opening up the strategy. So now our max loss would be about 100 and something, because the difference between the strikes is 100. And so when we would want to use this strategy is when we have a bullish outlook on the stock by expiration date, in this case March 25th, And we're basically selling the put credit spread so that, or basically because we think that the share price is going to stay above the strike price of the short put option. But we also think that the share price is going to rise higher than the strike price of the short call option, because that would be when we experienced our max profit potential. And our break-even points in this example are pretty easy to find out. We can see right here that for this strategy, I'm incurring a total credit at the moment. And so that basically means that my break-even point is equal to the short put strike minus the amount of the initial credit. So in this case, well, let me move this up a little bit so it makes it easier, so it stops shifting from total cost to total credit for the strategy. So we can see right here, I'm incurring a total credit, and the break-even point down here says 114.91, and that's because if the share price drops to 114.91, then that means that I will have incurred a loss of $9 on this spread, because it would be, or 9 cents on this spread, because it would be 115 minus 9 cents. And since I collected 9 cents to open up the spread, I'm collecting 9 cents and I'm paying 9 cents out of the loss of the credit spread. So that would be my break-even point if I'm incurring a credit to open up the strategy. But if I'm incurring a debit to open up the strategy, so let's move these strike prices back down here so that I can incur a debit like down here. Then I'm incurring a total cost of 12 or 14. In this case, the break-even point would be equal to the long call strike price, which is this one right here, 118, plus the initial cost of the strategy. And so the reason why that is because if the share price rises to, as it says right here, 118.10, then I will have incurred a profit of 10 cents on my call debit spread. And since I paid 10 cents to open up the strategy, then obviously 10 minus 10 is 0. So that would be my break-even point if I incurred a debit for the strategy. And last but not least, the max gain for this strategy is a capped gain because of the fact that the call debit spread has this short call option, which is making it so that the max gain is the difference between the strike prices of the call options. And then also we have to take into consideration the cost and the credit. In this case, it would be a total cost. So our max gain would be the difference between the call strikes minus the total cost. And then if it were a total credit to open up the strategy like this, then we would collect a total credit, and so our max gain would be the difference between the strike prices of the call options plus the total credit that we receive to open up the strategy. And that basically sums up everything to do with the double bull spread. Let me know in the comments section down below if anyone has any questions. I'd be happy to answer them. Leave a like on the video. It definitely helps this channel get recommended to more people out there. And subscribe to the channel, and I'll see everyone in the next video.